He made $47,000 in a single week. He sent screenshots. He quit his job. He called his dad and said, "I figured it out." For years later, he filed for bankruptcy. And the part that still haunts him? His college roommate, the one who literally never checked his brokerage account, retired early, quietly, without a single story to tell. This video is about a number. A number nobody in the trading world wants you to calculate, because the moment you do, the whole game falls apart. That number is not your win rate, not your return percentage, not your best month. It's what you actually keep after taxes, fees, time, and the cost of being wrong, compounded over a lifetime. Run that number, and three types of investors show up. One looks like a warrior. One looks disciplined. One looks boring. And the boring one wins by a margin so large it should be illegal. Let's do the math they never show you. Three people. Call them Marcus, Diana, and Sam. All 28 years old. All earning $80,000 a year. Same city. Same tax bracket. Same starting account. Zero. Same monthly contribution, $1,000, every single month for 32 years until they're 60. Same money in. Different decisions out. Marcus is the one who woke up at 5 a.m. to read pre-market news. He became a day trader, in and out of positions, sometimes dozens of trades in a single session. He has a setup, 3 monitors, a Discord server, a YouTube channel with 4,000 subscribers where he explains his edge. Diana is smarter than Marcus, or so she believes. She's a swing trader. She holds positions for a few days to a few weeks. She follows the trend, not the noise. She reads books. She uses stop losses. She considers herself a serious investor. Sam has a brokerage account and one fund inside it, a total market index fund. He sets up an automatic monthly purchase on the first of every month and has the app buried in a folder on page for his phone. He hasn't opened it in 6 weeks. He finds this topic genuinely boring and would rather talk about literally anything else. For the first 3 years, Sam looks like a fool. Marcus is posting wins. Diana is refining her system. Sam has a number that goes up, goes down, goes up a little more. No story, no edge, no screenshots. But there are 3 invisible forces already running in the background. And they will not stop. Not for a single day. Not for 32 years. Here is the thing nobody tells Marcus when he opens his first trading account. The IRS has 2 completely different prices for your profits, depending on how long you held the investment. Hold something longer than a year. Sell it. You pay long-term capital gains tax. Depending on income, that's 0%, 15%, or 20%. Hold something for 2 weeks. Sell it. You pay short-term capital gains tax. That's ordinary income tax, the same rate as your salary. Marcus is making $80,000 a year at his job. Every profitable trade he closes in under a year gets stacked on top of that income and taxed accordingly. We're talking 22%, 24%, maybe more depending on the year. What does that actually cost? Let's say Marcus has a genuinely good year. He makes $20,000 in trading profits. That's real money. He celebrates. Then April arrives. The IRS wants somewhere between $4,400 and $5,000 of it. Gone. Before it ever had a single day to compound. Now multiply that across hundreds of trades a year. Every closed position that made money, taxed. Every gain that could have stayed invested, rolling forward, growing. Instead, it left the account. Diana loses less here. She trades less. But she's still holding most things for under a year, which means she's still paying ordinary income rates on almost everything she makes. Sam? Sam barely sells anything. His gains are sitting there, untouched, compounding without interruption. The tax bill is deferred, not forever, but for decades. And deferred tax on compounding returns is worth an extraordinary amount of money, because that money that would have gone to the government stays in his account, making more money instead. This is not a technicality. This is the single largest invisible force separating these 3 people, and it starts on day 1. Every trade has a cost, not always a visible commission. Most apps removed those years ago to make you feel like trading is free. It is not free. There's the spread, the gap between what someone will pay and what someone will sell for. Small but real. There's slippage, The price moved a fraction of a second before your order filled. There's the occasional fee you didn't see. And in options or leverage products, there are costs baked so deep into the structure that most traders never find them. Marcus turns his entire account over many times throughout the year. Conservative estimate, even at 0.1% per round trip, that friction adds up to 2% of his total portfolio evaporating every year before he has made a single cent of profit. 2% doesn't sound catastrophic, but here's what 2% costs compounded across 3 decades. It is not a leak. It is a drain, and it runs every day the market is open. Diana's friction is much lower. This is a real advantage she has over Marcus. But it's not zero, and combined with the tax issue, she's still fighting uphill. Sam's friction? One fund bought monthly. Expense ratio under 0.05% per year. That's it. The cost is so small it barely registers. Let's set aside the theory and look at what the data actually says happened to real people who tried what Marcus and Diana are trying. Studies tracking tens of thousands of individual traders across multiple countries over more than a decade have found consistently the majority of active traders lose money relative to simply holding the market. Not occasionally, consistently. One study found fewer than 1% of day traders earned reliable, repeatable profits over time. Not 10%, not 5%, under 1%. A Brazilian study tracking people who traded for more than 300 days found 97% of them lost money. 97. The most comprehensive long-running data on professional fund managers, people with teams, algorithms, and every advantage Marcus will never have, shows that roughly 9 out of 10 of them fail to beat a simple index fund over 15 years. If the professionals can't do it with every advantage available, what is the realistic probability that Marcus, watching 3 monitors from his apartment, figures out something they missed? I'm going to be generous to Marcus and Diana for the rest of this video. We're going to assume they're both profitable. They beat the odds and actually make money. Because even the optimistic version of this story is devastating enough. Same inputs, $1,000 a month, 32 years, starting from zero. Marcus the day trader, after taxes, friction, and some losing years mixed with winning ones, earns roughly 5% annually on average, net of all costs. Diana the swing trader, lower friction, slightly better tax management, nets around 7% annually. Sam the index investor, historically a low-cost total market fund, has returned approximately 10% annually over long periods. After his nearly non-existent costs and near-zero tax drag from almost never selling, Sam keeps close to that. Here's where they land at 60. Marcus, approximately $835,000. Diana, approximately $1,220,000. Sam, approximately $2,170,000. Sam ends up with over $1.3 million more than Marcus. More than double, from the same $384,000 in contributions. And remember, we gave Marcus the generous version where he actually made money. The average day trader doesn't finish at $835,000. The average day trader finishes behind where a savings account would have taken them. But there's one more number, the one the spreadsheet can't capture. Marcus spent conservatively 1,800 hours a year on his trading. Market prep, watching positions, reviewing trades, managing his Discord, reading, improving his system. Over 32 years, 57,600 hours. That is the equivalent of working a full second career alongside his actual career for 3 decades straight. 57,600 hours of a human life pointed at a screen to finish $1.3 million behind the guy who set up an automatic investment and forgot about it. Diana spent far less, maybe 400 hours a year. Still, over 32 years, that's nearly 13,000 hours. 3.5 full working years. Sam, for hours a year, a few minutes each month to confirm the automatic purchase went through. Total over 32 years, roughly 128 hours. About 3 work weeks. The man who worked the hardest finished last. The man who barely showed up finished with $2.1 million and thousands of extra hours of his life intact. There's no version of this where the math says effort is rewarded. The market doesn't pay for activity. It pays for time in the market. So what actually works? It's not exciting. There's no course to sell with it. No Discord. No setup to buy. Put the majority of your investment money into a low-cost index fund. Every month. Automatically. Don't sell it. Let time do the only thing it's ever reliably done. Turn patience into compounding and compounding into wealth. If the urge to trade is real, wall it off. Keep it under 5% of your portfolio. Keep it in a tax-advantaged account if possible. Treat it as a hobby, not as your retirement plan. And before you make your next trade, calculate what you actually kept after taxes, fees, and time. Not what you made on your best week. What you kept compounded over a lifetime. That number is the only one that decides who retires rich. Marcus's mistake wasn't that he loved the market. It's that he confused the feeling of winning with actually winning. And by the time the difference became visible, 30 years had already gone. The boring investor didn't beat him because he was smarter. He beat him because he understood one thing Marcus never did. The market doesn't reward the most active participant. It rewards the most patient one.